Hello everybody, my name is Bookie and I'm here for the Good Eve channel. So today I'm going to be speaking about diversified investment portfolios. Do you have a diversified investment portfolio? So before I jump into that, I just quickly like to ask you up front to subscribe. If you like this content, please like and share the video. So no more, let's dive right into it. So what you're going to expect from this video today is what does diversification of your investment portfolio mean and why should you watch this? Well, if you have assets or you're beginning to set out and work on your financial plan or thinking about your financial future and you want to put things away for the future, you should definitely be thinking from the onset about ensuring that how you invest is diversified. So why should you listen? Because I'm going to explain what this diversification means and the different ways that diversification can affect you. And this will allow you to be more informed and to make better decisions about how you are going to structure your investments and the balance of your investments going into the future. So, like I said, what is a diversified investment portfolio? Well, it is a mix of different types of investments. This mix can include different asset types, such as stocks or shares. It can include bonds, and it could include real estate. It can also include currency like dollar, pound sterling, yen, cryptocurrencies, and different asset groups. It can include a mix of different types of the same asset. So what I mean by different types of the same asset, so for instance, if you have a lot of knowledge about real estate, it could be that instead of only concentrating your investments in commercial real estate, for instance, you could also diversify into commercial, residential. You could have a residential, commercial. You could do parking lots, for instance, which is a form of residential. You could do real estate investment trusts, which are like a real estate mutual fund where people come together and pool money. So you could explore different types of variations around, of those asset classes. So that can be a form of diversification. It could also be across countries. So if I take the example of real estate again, you could own a home in the US. You could own a home in the UK. You could own a home in Nigeria. You could own a home in Paris. Maybe you use all these homes for Airbnbs and some kind of income generating purpose. It could also be owning properties in different states and different hotspots. So location can also be a form of diversification, so that if there's an issue that's affecting one particular location or market, you're kind of insulated because you own properties across multiple jurisdictions. It also could be across different asset managers or investment companies. So for instance, you could hold some of your shares through Robinhood, then you could own some of your shares through Publix. You could own some of your shares through Edward Jones. You could own some of your shares through ARM or Stanbic. So that just that insulates you against, for instance, institutional failure risk, like the example of the Lehman Brothers or Barron's Bank that both collapsed in the 2000s. So imagine if all your investments were held in an institutional way in those companies. You would be in a very disadvantaged position because they are holding on to all your assets and they were the ones handling. You might be able to get some back if they were directly in your name, but if the asset companies had pledged those things, for instance, which sometimes they're allowed to do, I know sounds totally odd, but they're allowed to pledge your assets without your knowledge, depending on what you signed, right? So they have implied knowledge, then you might find yourself in a situation where your asset was pledged against a debt or an investment that they had made, and now that institution has failed and you're out of your money. Another form of mix is it could cut across different currencies. So for instance, you could hold Naira, you could hold USD, I mentioned this before, you could hold pound sterling, cryptocurrencies for those who are up and up for that adventure. And it can also cut across different, so the whole essence of diversification is about mitigation of risk. And so when you begin to think about diversification of your funds, you need to think about the risks that you're trying to mitigate against as an investor. So the starting point would be, are you a high risk? Are you medium risk? Are you a low risk? What's your kind of risk profile generally? Are you, it's supposed to be the higher the risk, the higher potential return, but also the greater the potential loss. And medium, lower return, lower potential loss, and low, even lower return and even lower potential loss, hopefully. But all investing bears with it a certain degree of risk. So we must remember that even bonds, even fixed income, if the institution with whom you have given your funds to put in a fixed income investment or even savings goes bankrupt and the amount that you've given them exceeds the insurable amount that the government insures for, you are only eventually going to get the amount that's covered by insurance. Anything above, over, and beyond that, you will not receive. So you must understand that all investing and all of these asset classes, they do bear them certain risks. And that's why I try to give you like a really full description, description of what diversification is. You want to diversify against institutional risk. You want to diversify against locational or an economy or locational risk, where that asset is located. You also want to diversify against industry risk. So if you're buying shares, you don't want to buy them all in one type, only tech, for instance, or only food, or only real estate shares. You want to diversify, only pharmaceuticals. You want to diversify to cut across multiple industries, right? So that will help you kind of, balance out your industry risk. And then you also want to, diversify across different assets at some point. Now, I know that this can sound overwhelming. How will you do all of this? You mean I can't just buy a house and set it and be done? I have to buy stock. I can't just buy one type of stock. I have to buy a variety of stock. I can't just hold one currency. You're telling me I have to hold currencies across multiple? Don't worry. I know it sounds overwhelming, but these things are taken step by step. And so, let's start by talking about how you would start this process. And so you'd want to answer this question: what determines the mix of your diversified portfolio? What determines the mix of your diversified portfolio? And so there's 6 things I'd like you to think about when you begin to kind of think about diversifying and investing. So first, what are your goals? So what kind of assets do you want to be? What kind of retirement do you want to have? What kind of lifestyle do you want to live today, in the future, on an ongoing basis? How many sacrifices are you able to make financially, depending on where you are? What kind of sacrifices are you able to make financially, depending on where you are? You also need to look at those things in terms of your goals. Look at your age. And we say this about age because whether we like it or not, if you're 65, you're closer to whatever your retirement date is, whether it's 90 or whether it's 66, than someone who's 25. And so if you're older, you're probably going to be wanting to take a little bit less risk. If you're 25 and you have a high risk portfolio throughout, you can lose everything. And guess what? You can just pick up and start again because you're still not yet in the peak of your earning years. If you're 65, you'll probably have passed the peak of your earning years. And so you need to be really careful about where you put your assets and about how much you can risk. So your age really impacts what kind of risk. We typically say for people in between 20 to 30, they could be like a high risk mix. Once you're getting into your mid-30s, late 30s, especially once you start having children. So in America, people have children a bit earlier than probably in Nigeria in many areas. So if your kids are already in high school by the time you're 30, you need to be thinking about medium risk, not high risk, to your 30s, mid-30s to your mid-40s. And then by the time you're getting into your 50s, mid 50s, you want to be thinking about low risk in your mix of assets for your investment portfolio. Number 3, so how many years do you have to achieve your goal? And I've kind of talked about this in relation to your age. So you might be 35, but if your goal is to retire by your 40, that's a goal, that's a 5-year goal. However, if you're 35 and your goal is to retire when you're 65, hey, you have 30 years to achieve your goal. So your mix and the person who's retiring 30 years as their goal, and the person who's retiring in 5 years as their goal, your mix of assets are going to look very, very different because you have very different goals. So bear in mind, think about it. How many years, more years do I plan to work? Number 4, you need to think about your temperament. Look, there's some people that have a high threshold, a high tolerance. They eat stress and challenges as their morning breakfast. They pour some milk in it, they grab a spoon, and they love it. They love that, people who thrive on that. Whereas there are other people who like peace. They like to know where things are. They like to know when things are coming in. They like certainty. Think and look at your temperament. If you are someone that doesn't like risk, you don't like unnecessary challenges, you don't really enjoy the excitement and the adventure of, I don't know if my money's coming in or not, I don't know if this thing will work out or not, and you don't have that threshold, your temperament, and this doesn't matter how old you are, then it's better for you, remember, slow and steady wins the race as well. So it's better for you to take your time, be more deliberate, and perhaps do things that are less exciting. That will also guide the kind of assets and asset mix that you look at in terms of diversifying your portfolio. You need to look at your access. So there's certain investments you may want to do. So for instance, if you're resident outside the US and you want to invest in the US stock market, certain stock institutions, like investment institutions, don't cater to foreigners or non-resident US citizens who want to invest in the US. And for a long time, the Nigerian market was the same way. So we've seen some changes in this. There's been some room and some avenues that allows for cross-country and global access. But you really need to think about that. For instance, I know in certain states in the US, you can't own a home there unless you are a resident of that state. So you can't live in Florida and own a home in another state, in that particular state. And I mean, I don't want to call any state out, but there are some states that require you to be a resident of that state. So access, will you have access? Will you be able to check on your investments? Do you have people who will be able to check on those investments? Will you be able to have access to your funds? If you're holding cryptocurrency, for instance, you must have access to your wallet. So that means, of course, it's so basic, but you need to have good internet access. You need to have a place where you can secure your phone or your laptop or your devices in which this information sits. It sounds basic, but there's some people who don't have that. They just don't have maybe the capacity, or they're not that technology friendly. And so if you know that you're not going to have that access, focus on investments that you can have access to, because monitoring and being able to move and reposition your investments from time to time is also very essential. Your level of knowledge. Warren Buffett, and it's like I'm saying this in every video now, but it's such a good point. Only invest in things that you understand. He doesn't invest in things that he doesn't know about or doesn't understand. Now, what does that mean for you? Get the knowledge. Build your knowledge base. Spend time. Don't just watch one article or one YouTube video or 3 or 10. Read books. Read articles, go to credible sources. They're usually boring, but you know what? That boring means, there's something there, it's something authentic. Make notes, talk to experts that you know in that industry. Someone's saying, oh, it's so great. The price of oil and gas, is, it's so high right now. Oil and gas is where it's at. Fine, talk to someone. If you happen to know someone that works at an oil exploration company, have a conversation with them. What are the challenges in the industry? Why do some players do better than others? Speak to people that can really give you a deep understanding, and listen to learn, not just to jump in, because they can be an industry that's should be doing really well, but you always have some, people who are bottom of class. They're just not doing as well. They're just not as well organized. The management isn't very good. Their, ethics are an issue, oversight, governance, controls. Whereas you have another organization in the same industry, it's doing 10 times, 20 times the kind of profits that the other company is doing, because they have the right processes, procedures, protocols in place. So you need to kind of ask questions, look into that information. So don't just buy the cheapest asset just because it's cheap. Look out for value. And you can't know that unless you build your knowledge base and you understand. So when you're thinking about your mix of assets, start with the ones you have a bit of knowledge on. Now, I've given you these 6 kind of thought points that you need to consider as you build your portfolio. So right now, I'm not saying go sell down everything you have. No, but if you sit down and you think, all my assets are invested in only one type of real estate, let's say residential real estate, then you can think, okay, if I'm going to diversify, do I want my next step to be diversifying into stock or shares? And then think through, don't just buy one, buy a mix of shares. So that's, you take that step. And then maybe 2 months from now, you've gathered up a little bit of money again, you're doing your consistent monthly investing. And then you can say, okay, I've done shares. Okay, I want to do currencies. And then you can begin to put a little bit in currencies. And before you know it, you look back a year, 2 years from now, you find that all these different buckets that you didn't realize you needed to have started to get to gain some momentum. So that's kind of the way you want to approach it. As always, you want to talk to a professional, an investment professional. For the purposes of this video, it's for entertainment purposes only. So definitely you want to talk to an investment professional who can give you some better guidance about diversifying your portfolio. So my conclusion is a portfolio, especially a diversified investment portfolio, should insulate you from the total impact of shocks in whatever market in which you're investing. But it only works if you actually take the steps to do it. So make sure that you take the steps and just do it. Thank you for listening to this video today. Please subscribe, like, share, comment down below, and I'll see you in the next video. Bye for now.